Hello, my name is Stephen Baker. I'm an Employment Taxes Director here at BKL, and we now know from the budget that a major announcement has been made on the introduction of new rules around the treatment, the NIC National Insurance treatment of pension salary sacrifice. This is something that's been long expected, so we were buffeted and prepared for this in the profession, but we now have the details, which I'm going to talk through a little bit now. These changes will come in from April 2029 and apply to any employers that have in place a pension salary sacrifice whereby their employees contribute to an occupational pension fund and give up part of their salary to do so. That is in essence what a salary sacrifice is. The employees reducing some of their taxable pay in return for the employer making an enhanced employer contribution. Now, an exemption will apply of £2,000, so NIC will only be payable on the amounts made over and above that £2,000 limit from April 2029. We know that employers' national insurance will not be due on pure employer contributions that aren't made via a salary sacrifice. And I suspect that measure is there because one of the largest employers in the UK is the civil service and public government departments, and they don't contribute via a salary sacrifice. So if this measure was extended to all employer contributions, it would bring into the net of national insurance some large employers that don't have that ability to do salary sacrifice. So how is this going to impact you? Well, I suppose the first thing to say is don't panic. We have a long time before these measures are coming in, nearly 3.5 years, April 2029. So if you're currently doing a salary sacrifice, there's no need immediately to change anything. You can continue to benefit from tax and national insurance savings, and it remains the most effective way to contribute into an occupational pension. However, over the coming years, there will be time to both model and assess what the impact of these changes will mean for you and your employees from April 2029. So whilst don't panic and change anything immediately, always have one eye on the future as to what these changes are likely to mean. So it's a case of consulting with your HR, people and culture, payroll and pension providers to look at the likely impact assessment this is going to have on you and your benefits provision, your compensation strategy. Once you've done that, it's time to determine whether or not you wish to revert to a state before salary sacrifice, where you have a traditional employee and employer contribution going into pension fund, or does it make sense to continue with the national insurance savings no longer being available, but salary sacrifice still being the most effective way for things like tax relief or higher earners? It's also worth bearing in mind that salary sacrifice does allow employers to effectively subsidise or give back some of those national insurance savings to employees, and many employers will effectively top up the pension fund. This change is going to challenge that long-standing condition and that long-standing approach to funding salary sacrifice and funding pensions. So that needs to be built into the impact assessments being undertaken between now and April 2029. How are those extra funds going to come? Which is why if you don't have a salary sacrifice in place at the moment, that's nothing to say you can't implement one for that short period of time, that 2 or 3 year window, to crystallise some of those national insurance savings that are available, which will then offset the increased charge to come in from April 2029. So clearly these things need to be looked at in the round. We have increased the national minimum wage and other measures around income tax and national insurance bandings being frozen. So this is a whole suite of measures that are designed to increase the tax and national insurance take. And interestingly, the salary sacrifice measure is the largest single contributor to the tax and national insurance being raised by the budget, the other being the freezing of the personal rates bands. So this is an important measure. But one final thing I would say, other than don't panic, is these measures are mooted to come in April 2029. That is the same year as a general election, which the latest it can happen is August 2029 because of the Fixed Term Parliament Act. I've been working in tax for over 20 years now, and I've seen a lot of measures proposed and delayed. Most recently, the changes around payroll and benefits was delayed by 12 months, and IR35, we all remember that being delayed by 12 months. So just because this is mooted to come in April 2029, it doesn't mean it might be delayed another 12 months. And that would put us squarely into general election territory. So this is something that could be pushed down the road because it is the end of the current parliament. And this is something that has proven to be quite unpopular among employer groups and various committees that I sit on and join in. So it's not automatically a given that this change will come in, or it might be deferred, because it will have a seismic impact on employers and the employer benefit proposition. So if you have any questions or you wish to reach out, please reach out to your normal BKL contact. We'll be happy to engage with you. But as I say, my one takeaway for now is don't panic, because these changes are 3 years in the future, but to model, assess and consult with your advisors on what these changes will mean for you.